Hi, I want to thank everybody for joining us for today's session with Millionacres. Our live webinar today is going to go about 30 minutes or so, and we are recording the session. So if you want to share this with anybody else when we're finished up, you'll have an opportunity to do so. Before we get into it, I just want to take a quick check on who Millionacres is, so you know who you're talking to and why we think we've got the right to be chatting about these topics today. So first and foremost, we are a motley fool service dedicated to making the world smarter, happier, and richer, specifically through real estate investing. The company is staffed by experts in real estate investing, almost exclusively, and we provide expert analysis and investment recommendations for our subscribers to our premium services. With that, I want to go ahead and transition and introduce our speaker. Deidre Woollard is an editor here at Millionacres. Her background in real estate began as part of the blogging team for AOL, and she later worked at Move Inc. with Realtor.com's communications team and handled marketing and communications at top residential real estate brokerages. Real estate investing is a family tradition, and she comes from a long line of landlords, renovators, and contractors currently invested everywhere from Massachusetts to California. She has an MFA in writing from Spalding University. So I'm going to go ahead and turn it over to Deidre. Deidre, please take it away.
All right, thank you. And hello, investors. I'm really excited to chat with you today about real estate investing. I've studied real estate for over 20 years, and wow, 2020 was one of the most challenging in recent history. It was impossible to predict what was going to happen next. The COVID-19 pandemic and the measures that federal, state, and local governments took to mitigate the spread just had this profound impact on our everyday lives. And all of those impacts have been felt deeply across the world of real estate. And there's some negatives to that, but also some pricing positives. And one of the things that I profoundly believe is that the pace of innovation really sped up in 2020. Things that were already in progress kind of got really accelerated. And we're going to talk about some of those today. One of the reasons that I love studying real estate is because it's directly connected to human behavior. So everything that we do, where we go, where we shop, where we work, all of that is, of course, connected to real estate. And we say at Millionacres that money follows people, and I think you're really going to see that today. So today we're going to cover 4 different trends that dominated 2020, and they're going to be even more important in 2021. And when we look at these trends, we're not just looking at what is happening, which is obviously totally fascinating, but we're also looking for those investable ideas. So the first trend that we're going to go over, it's probably one you've experienced in your own life, and that's the rapid acceleration of e-commerce. And when I say rapid, wow, it pretty much went into hyperspeed in 2020, and there just seems to be no end in sight. In fact, e-commerce and digital retail experienced about 5 years worth of growth in 2020 alone. According to the St. Louis Federal Reserve Economic Database, e-commerce retail sales as a percentage of total sales jumped from about 11.8% in Q1 to 16.1% in Q2. And according to the US Census Bureau, the third quarter 2020 e-commerce estimate increased 37% from the third quarter of 2019. So that's interesting, right? But where's the real estate? Here's the thing that most people don't know about e-commerce. It really takes a lot of real estate to keep it going. That means that the companies that really thrived during this rise of e-commerce, like Amazon, Walmart, some of the other e-commerce giants, they are desperate for warehouses and fulfillment centers, especially around key population hubs. And despite the fact that there's billions of square feet in new industrial development and it's been growing over the past few years, we're still in a situation in which we need more square footage. In fact, JLL projects over 1 billion square feet of additional warehouse space needed by 2025. And in that report, Craig Meyer, who's JLL's president of industrial services, and he's been in the industry for 4 decades, he said that since 2011, industrial rent growth has been positive and vacancy rates have been at historic lows. So usually that sort of track record might make us think, okay, this is a real estate cycle that could be near capacity. But that's not the case just because of this rapid expansion of e-commerce. According to CBRE, e-commerce will need an additional 400 million square feet of warehouse space just for the processing of returns, not even including everything else. And Cushman and Wakefield says that the forecast for North American industrial absorption from 2021 to 2022 is around 480 million square feet. And beyond that, they're also forecasting that vacancy rates are expected to remain stable even as new supply comes online and solid rent growth is expected. And it's not just e-commerce. It's not just that people have pivoted to buying online. There's another factor that I think we all experienced last year, and that's supply chain dynamics. Anyone who went through the great toilet paper shortage of 2020 knows that there was a supply chain problem, and that was a lesson for all consumers certainly, but really for retailers and manufacturers. So that fragile supply chain and how manufacturers and retailers bolster that up is also going to fuel this rise in industrial real estate. Another factor there is that because of that, in 2021, we're expecting to see manufacturers look to bring that manufacturing back home. In fact, in early January, US manufacturing hit a high that hadn't been seen in 14 years. So that potential industrial warehouse supply deficit gets even more acute when you factor in insourcing or near sourcing, which means bringing manufacturing, especially things like medical devices and supplies, close to home. Another factor that is huge right now in industrial is cold storage. Talking about supply chain dynamics, the need for fresh produce, think of all of those meal services sites like a Blue Apron or a HelloFresh. All of those services need a lot of square footage in cold storage. And even when global trade resumes normal levels, that's just going to create more opportunity for some of the industrial real estate investment trusts that we've been following that are invested all around the world. So all of this is really kind of coming together. And one thing that I wanted to mention is that the high demand is creating a premium for existing square footage. Through our Mogul premium service, we had an industrial park development deal in the Dallas-Fort Worth metro area. And that project was, very exciting before the pandemic, but after the pandemic, it has been able to lease out its buildings at an average price per square foot of 11.4% higher than the initial projections. So it's just this huge upside for industrial. And we don't see this trend as diminishing anytime soon. According to research, just looking at groceries alone, the share of groceries sold online is expected to more than double from 2020, where it was around 10%, to 2025, when it's going to be over 21%. So that ties back to that need for the cold storage to hold all of those perishable goods. So you might be asking, and I think everyone is asking, well, where's the square footage going to come from? And of course, the answer to some extent is more development, but you're also seeing this need for last touch fulfillment centers, which means that last mile warehouse delivery. So we're looking at retail or mall conversion to warehouse and distribution centers. That's already happening. We think that's going to continue. There's just a lot of ways that industrial is changing. And another factor that we're also looking at is automation, because these warehouses aren't just warehouses, they're a complicated ecosystem. We're going to see more robots. We're going to see more automation. We're going to see more tracking. And we may also see some more vertical warehouses in infill development. So however it comes, warehouse space where you need a lot more of it, and it's going to really fundamentally reshape a lot of commercial real estate. And for me, that makes it a highly investable idea. All right, now on to our second trend. And this one might seem weird because it's office real estate. So a lot of people went to remote work in 2020. All of these companies that said they'd never allow remote work changed their tune really quickly. In New York City, less than 20% of workers that went remote are back at their desks right now. And we've seen companies say that their workers can be remote for the rest of the year or potentially even longer. But here's the thing. At the same time, you're seeing companies like Amazon, Google, Facebook build lavish new offices. Amazon just announced last week in Arlington, Virginia, their really beautiful campus for HQ2. So what gives? Well, one of the things that we've learned, and I think certainly a lot of us experience this, is we kind of miss the office, believe it or not. And some of the CEOs are saying, great, work from home, but others are saying that maybe it's not all that great. Last year, in an article in the Wall Street Journal, Reed Hastings of Netflix said, not being able to get together in person, particularly internationally, is a pure negative. So we know Netflix won't be all in on work from home anytime soon. But at this point, the jury's kind of still out on how much remote work's going to dominate in the future. But one thing we know is the office building is going to change. We're probably not going to see a bunch of people packed into an open floor plan anymore. And really, we're going to see a hybrid environment. Companies are already figuring out what that's going to look like. Future of offices is probably going to have more technology and probably more private spaces because a lot of people in the office will be connecting with people outside of the office, and they're going to need privacy to do that. So the overall square footage, as odd as it sounds, may actually not go down. But the other thing that we're really watching in at Million Acres is the boom in life science real estate. And life science is interesting because it straddles the office and healthcare sectors to some extent. And it really refers to any buildings where there are labs or research facilities. So this is the type of work that really can't be done at home. And in the past year, the demand for life science real estate just went nuts. And part of that is COVID related, and that's a short-term trend, but there's also a longer-term trend at work here. The aging of America. We talk about money following people. Well, one of the things that the baby boomer generation wants is not just to live longer, but they want to live better. So this is a trend that's directly tied to demographics and human behavior. Last year, one of the biggest healthcare REITs, Ventas, they spent $1 billion on a life science portfolio in San Francisco. And in just the first half of 2020, over 16 billion was invested globally in life science companies. So all of those companies, they need space. And according to CBRE, total commercial lab space increased by 12% in 2020. And so that is just a huge trend that we're following. There are several, there are investable ideas in there too. There are REITs that focus on life science. There are also individual commercial real estate projects. And we're not really ruling out that renaissance in traditional office either. Cushman Wakefield has said that they believe office leases will go back to pre-COVID levels by 2025. And we're already seeing what's happening as vaccines reach critical mass and companies may start asking people to be in the office. It's probably still, at least for the short term, going to look that hybrid or distributed office. But the interesting thing about the distributed part of that is you're going to see perhaps suburban office parks come back. Also, perhaps a return to co-working. In the future, we may not have just one office we go to. You may go to the headquarters for meetings, but you may, when you just need someplace else to work, go to a co-working facility or a smaller office. So this is a really fascinating trend that is going to be shifting. So just keep an eye on that one. All right, let's take a look at trend 3. And that is retail and hospitality, which obviously these two sectors had the worst of it in 2020. But I'm really looking at seeing something kind of exciting happening. I'm looking at some of the earnings for retail REITs and other companies, and I'm starting to see this optimism. And part of that started last November when the vaccines were announced and started to roll out. We immediately saw shares of retail and hospitality REITs kind of poke back up. And so this optimism is really, it's great to see after a tough year. But the interesting thing is right now we kind of exist in a weird, like a liminal space, because we're in this space between people are getting vaccinated. Right now, it's mostly focused on seniors, healthcare workers, teachers. And this process is going to take a while. We're already seeing some of the news is talking about how hard it is for people to get vaccines. I know a lot of us are trying to get our loved ones vaccinated, and knowing that if you're younger, you might be waiting for a long time to get your vaccine. So during this time period, some people are vaccinated, but the most aren't. So you're still seeing those restrictions in place, and that's still putting a lot of pressure on retail. It's putting a lot of pressure on hotels, restaurants. It's all still pretty rough out there. But what I'm seeing also is these retail and hospitality companies, they're really looking to the future because they believe, and the trends are showing, that by the middle of the year, things should start normalizing. So that makes this really interesting to watch. And the question that I'm thinking about too is that pent-up demand. I saw a recent study about 97% of people didn't take a vacation last year. People, we didn't feel safe to go. We didn't feel safe to shop. Most people did their Christmas shopping online. All of that is leading to a lot of pent-up demand. And so when we look at the future of retail and we look at the future of hotels, we want to look for these companies that have places and locations that people really want to go to. When you look at malls, a lot of that is coming down to tenant mix. You've probably seen a lot of retail Chapter 11 filings. They happened a lot in 2020. We've already seen several large ones in 2021. Not all of them lead directly to store closures, but a lot of them may. And what we're seeing is really this kind of right sizing of retail. And it's been rough for some malls. Some malls have already gone back to the lenders, but I'm also noticing store expansion. Chipotle recently announced their earnings, and they said they were going to open 20 restaurants in 2021. Aldi, which is that lower priced European grocery store, they're opening 100 new stores this year. And so that ties to the essential retail, which we saw huge in 2020 with grocery stores. But we're also seeing this new world in which buyers are combining in-person visits with online ordering. So everybody shopped for their groceries online last year. Everybody got accustomed to it. But now we're going to see people doing online ordering maybe for their essentials, but still wanting to go to the grocery store. Why? Because we still want to discover things. And discovery is a key factor here when it comes to pent-up demand, is that we miss doing things. We miss seeing new products and things like that. The other trend that I see as positive for retail is during 2020, you saw a lot of direct-to-consumer brands really come out and get stronger. Those brands and some of the other brands that thrived last year are also looking for brick and mortar space. So the new mall may have a lot of different things in it. I'm looking at things like cosmeceutical, people getting skin treatments and things like that. There's so many things that connect to the mall of the future. And this also overlaps with travel and hospitality. It's been really rough for hotels. We're going to see distressed hotel assets up for sale in 2021. And already there have been a lot of large investment companies that have kind of been pooling together their capital, getting ready to pounce. So far, the commercial real estate prices haven't quite made the pounce happen yet, but we're really watching that. But there's some really exciting things about top tier hospitality, and that is that you're seeing people want to vacation again. You're seeing companies that do remote work are saying, well, maybe we'll, instead of having everyone in the office every day, we'll do a retreat every 4 months or something like that. So that's really interesting to look at. And one thing I'm thinking about is how much will business related travel and hotel stays lag behind tourism? So far, I'm seeing a lot of conferences start to be scheduled in really from October on. So I believe that by the second half of 2021, we're going to start to see a lot more answers to these questions. So my advice to investors is to keep an eye on those top-notch operators, both in retail and in hotels, and those that have destination assets in their portfolios. Last trend I really want to go into is housing, and specifically multifamily housing. I've been studying the residential real estate market for decades, and I really have never seen anything quite like what happened last year in residential home buying. We saw the market really kind of pause in March and April and then just go crazy. Bidding wars are common. Homes are staying on the market, less than a month. Inventories down below 2 months, which is way, way below historical norms. And sales of homes are expected to go up between 15 and 20% in 2021 due to forecasts from Zillow and the National Association of Realtors. But here's the thing. These prices are going so high and not everyone can afford to buy. So that leads us to multifamily. And the other thing that is driving multifamily is increased household formation. So a lot of people sort of went into quarantine, maybe younger people moved back home. You saw student housing kind of dive as people kind of consolidated or moved back home or didn't go to school. So all of that as it starts to end, we're going to see a resurgence in multifamily occupancy. And we're kind of already seeing it happen. Some numbers from CoStar, the net absorption of multifamily units in the third quarter of last year set an all-time third quarter record with over 110,000 units. And that was really the first positive sign because the previous quarter showed that net absorptions were pretty weak, which meant that renters really weren't picking up all of the supply that was on the market. But there's another thing that kind of worries me, and that is about the difference between types of properties. So let's talk a little bit about that. Class A properties, those are the ones that are in coastal cities. They're the top tier properties. They have the most, highest rents, most amenities, things like that. Those right now have the highest vacancy rate, north of 10%. And if you've been watching rents falling in New York, rents falling in San Francisco, at one point last year, rent for a studio in San Francisco was down, over 25%. Really, really striking, and striking statistics. But the demand for workforce housing, which is really what we'd call a uh, Class B rentals, they have around a 5.4% vacancy rate. And the problem is that there's so much Class A under construction. In fact, more than 80% of around 560,000 units under construction, they're Class A. And another factor here is the difference between rental rates for Class A and Class B has been growing. So all of that is putting a lot of stress on these Class A properties. They may not be able to raise rents. They may have to offer rent incentives. Certainly in New York City, that's one of the things that we're seeing right now. Lots of rent incentives, whether it's a month off or gift cards, anything to get people interested in renting. And that need for workforce housing at the same time is putting a lot of pressure on Class B and being good news for Class B rental portfolios because they may be able to raise the rent a little bit because there's such that big gap in the prices between the Class A and Class B properties. Other factor here I wanted to talk a little bit about is migration. The interesting thing about migration over the past decade has kind of slowed, but last year it picked up a bit. And you probably heard about the urban exodus where people were leaving San Francisco, New York, Chicago, and where were they going? They were going to Austin, they were going to Florida, they were going to Reno, they were going in some cases, they were going to more remote areas. Aspen had a good year in real estate. Cape Cod had a great year in real estate because people started to consider that remote work option. So we're seeing something really interesting. And one of the things that we were looking at Millionacres before the pandemic, and is even more true now, is Sunbelt cities. And so that's everywhere from Phoenix, Arizona to Jacksonville, Florida, just really the lower quadrant of the country has seen a lot of migration. Phoenix in particular is one of the places where home prices increase the fastest. So keep an eye out on that and for all of that migration that's happening. Some of that is probably COVID related, but the overall trend that was existing before COVID is definitely towards the Sun Belt. We're keeping an eye on cities like Charlotte, cities like Atlanta. Those are all really investable places right now. And one more trend that kind of connects to multifamily that I just wanted to hit briefly is single family build to rent. So talking about those home prices and people not being able to afford, a lot of people still want a single family home. Single family home rentals, there just aren't enough of them. So one of the things that is starting to happen is single family build to rent rental communities. D.R. Horton recently did this. They sold their first full build to rent community. They announced it during their last earnings. And that sort of shows that if these home builders aren't able to sell their homes, they may start focusing on build to rent, which is an interesting thing if you're watching the home builder market. And just yesterday, I saw the news that another company had announced a similar project with Dreamfinder Homes, which happens to be one of the builders that is based in Florida, which is one of those hot Sunbelt markets that is really, really fascinating. So all of this is just the tip of the iceberg of what the analysts and team members and all of us at Millionacres are kind of focusing on in real estate in 2021. And so now one of our analysts wants to give a special announcement, which I'm really excited about. So I'm going to pass the mic to Matt Frankel before we wrap up with some closing remarks.
Hi, can everybody hear me okay? Excellent. So I was thrilled to join Real Estate Winners when we started the project as a senior analyst, because I've been known as the REIT guy at the Motley Fool for a long time now. And I'd just been waiting for a way to really sink my teeth into something real estate that we were doing here. I believe it's a really underfollowed and underutilized asset class by many of today's investors. So I jumped on the chance to bring some of these opportunities to our members. So speaking of some of our excellent opportunities, we've had some great success already. We only launched Real Estate Winners in September 2020, so less than 5 months ago. And we started it with 10 of our favorite REIT and real estate stock opportunities. In the time since, I'm really proud to say that 3 of those initial 10 have doubled or more. In all, our portfolio has delivered a total return more than twice that of the S&P 500 in the time. And this is real estate stocks, which are not considered high growth assets by many investors, but they really are. So usually our official recommendations are only available to Real Estate Winners members, which you'll hear a little bit more about in a minute. But we're going to reveal one of our biggest winners here for free right now. And so this is not just a stock that has already doubled, which it has, but we feel that there is still a lot of potential for it to grow. So the name of the company is called Ryman Hospitality Properties, as you're seeing on your screen right now. This is a hotel real estate stock. It's a real estate investment trust. It owns 5 hotels under the Gaylord brand name. It has risen by 101% as of 2 days ago, since our September recommendation. It owns the 5 Gaylord hotels. These are 5 of the 6 largest hotels in terms of convention and conference meeting space outside of the casino industry in the United States. So large scale hotels. They also have a portfolio of entertainment assets, including the Grand Ole Opry and Ryman Auditorium venues in Nashville. They own a restaurant chain that's rapidly expanding. They own a streaming service called Circle that recently launched. So obviously the COVID pandemic was rough on Ryman. Group events just are not a thing right now. People aren't going to concerts for the most part. People are not having group meetings and things like that. So the market really lost sight of the long-term potential of Ryman's assets, which are just iconic and irreplaceable venues. But we didn't. And it's really paying off nicely for those who got in when we recommended this stock. So we don't think Ryman's done yet. As I mentioned, they only own 5 hotels. There's a lot of demand for group events in the United States. There are already big expansion projects underway at Ryman's properties. And there are a lot of untapped markets that could use large scale convention hotels, because not everybody wants to go to Las Vegas to have a giant gathering. So as a Real Estate Winners member, you would have full access to a full report on Ryman, the other 2 recommendations that have done even better than Ryman in less than 5 months, at least 1 new recommendation each month, and about a dozen other recommendations we already have active on our site that we feel have incredible wealth building potential over the years. So we hope that some of you will join us on our Real Estate Winners journey. And I believe Kevin is about to let you know a little bit more information about the service.
Yeah, and as somebody who's actually been to about a dozen trade shows at Ryman Properties, they are the finest in the country. And that's a company that's just going to continue to thrive and do very well, no question about it. So for Deidre and Matt, thank you both for great content as always. Our efforts here are to educate first and give everybody knowledge that you wouldn't get through regular channels, so that you can improve your overall portfolio. We do that on a regular basis through Real Estate Winners, and Millionacres is a subscription-based service. You basically sign up for it, and then as a member, you're going to receive reports on a regular basis. You're going to get at least 1 new recommendation each month. just like the one that Matt just talked about. There's updates on our recommendations following earnings announcements and other important events. There's educational content and resources to make you a smarter real estate investor. And then there's quarterly top 10 investment alerts, which are delivered instantaneously. So some really great value there. You can go, when you go to sign up, we are part, as I mentioned, of the Motley Fool. So you'll go to fool.com and then you'll see Millionacres Lunch. And that's a code that you will use if you choose to sign up after this event. So again, I'll leave it up there for a second. Fool.com, Millionacres Lunch is the code. We are offering our webinars, which are predominantly educational in nature. I learned some great stuff from Deidre today. I'm sure you did as well. So save the date for March 9th at 12 p.m. Eastern time for our next live webinar. This one's going to be really, really interesting. It's the rentals market you have not thought about with Lisa Phillips. She's a great speaker. She's authored a number of the books. She's a rental guru in alternative rental markets. And there'll be some more details and links on how to sign up. Will follow this session today. Again, I want to remind everybody, if you want to take advantage of the recommendations like Ryman and the other work that we're doing here, sign up at fool.com, Millionacres Lunch. Okay, again, down in the corner here. And with that, I want to thank everybody for joining us today. It's been great to, have an opportunity to talk to everybody, and thank Deidre and thank Matt again for their great content. Deidre, if you want to go ahead and sign us off.
All right, thank you so much.